Back with closing trades right here in 80 now. We're holding out quite okay. That little bit of choppiness, of course, played out largely to do with the way the Nifty Bank was panning out. We're definitely off from the top of the day, but we're still holding on to the 24,300 plus mark on the Nifty futures. Axis, SBI, L&T have got to be your key pressure points today. Other than that, M&M, Unilever, but again, these are stocks which have had a phenomenal run all through this week. They're also pausing a bit. Reliance as well has flattened out. Interglobe Aviation has flattened out. And Maruti, the top performer perhaps this week from the Nifty 50 names, that's also looking pretty quiet in trade as we speak right now. Sunny Agarwal also joins in on the show to talk about what he's making of the market right now. Sunny, hi, afternoon. Good to have you on the show. Let's try and dissect what you're reading for the large cap banking names, Axis, SBI, Kotak, HDFC Bank.
Good afternoon, everyone. Coming to banking name, the kind of provisional update which we are seeing for 1Q seems that the credit growth at least will be in a kind of mid-teen numbers for most of our banking measures. And as we have seen that because of a lot of liquidity measures taken by an RBI, even mobilization of deposits should not be a challenge, especially on FCNR side, which will be one of wherein the key beneficiary will be predominantly private sector players like HDFC, Axis, and to some extent on PSU side, Bank of India, which has got or Bank of Baroda, which has got a significant exposure as far as international markets are concerned. So overall, banking as a sector looks very well placed to deliver a healthy double-digit kind of earning growth for FY27, predominantly led by stability in the NIM. Maybe 1Q we may see to some extent minor pressure on NIM, but overall on a full year basis, the NIM should stabilize and that should aid a decent earning growth going forward. Even in terms of asset quality, we have seen no deterioration as per the various banks which have reported a provisional update. Even on valuation side, valuation continue to remain comfortable. Most of the private banks are trading closer to 1.8 times to 1.9 times price to book multiple, whereas PSUs are trading in the band of 1.2 to 1.5 with a kind of mid-10 ROE number that is expected going forward. So I think well-placed banking as a sector is well-placed. Obviously, within that, what we feel is that HDFC Bank in FY27 may report a kind of industry growth at par with an industry. And then in FY28, we may see a growth exceeding the industry. So a top pick among the private sector remains among the large cap private sector pack is ICICI Bank, where we feel it will continue to outpace the industry growth. Among the mid-sized bank, what we feel is that few players like Federal Bank, Karur, CSB should do well.
Sunny, what's your sense of earnings growth for FY27 within the banking pack? Will it be mid-teens? Will it be just about double-digit? What are you penciling in?
Again, coming to banking pack, what I feel is that few players which are outpacing an industry credit growth, they may report 17 to 18% kind of earning growth. So few players which comes to my mind is Axis Bank, where we have seen a kind of muted performance during the FY26. So on a low base, FY27 should turn out to be a better year for Axis Bank. ICICI Bank continue to deliver an outstanding performance going forward. For the likes of HDFC Bank, again, the growth should be in the range of 13 to 15% for FY27.
Okay, let me go across, just take a bit of a pause on the conversation, go across to Snehi. A broad-based moderation in key raw material prices could provide relief to several FMCG companies. Cocoa, copra, crude oil have all corrected sharply in recent months, potentially supporting margins for companies across food, personal care, paints, home care. Snehi here with the trends.
Well, absolutely. If you take a look at the raw material momentum that we've seen coming in across the board for a lot of FMCG staple companies, a lot of their key raw materials have seen a deflationary move in the month gone by. We've got the war pressure also that is now receding, and on the back of that, you've got Brent crude. Let's start by talking about the sectors, the companies that fall under paints, packaging and personal care. The biggest downfall coming in on Brent crude, 16% lower, and the likely beneficiaries are companies that use palm VAM derivatives as a raw material. So you've got Asian Paints, Berger, Pidilite in the chemicals front, Dabur, Marico, HUL. All of them stand to be the biggest beneficiaries of the 16% softness that we've seen on a month-on-month basis in Brent. For Copra then, Marico has been in focus on the back of its Q1 update, and the biggest reason why it's done so well is that there has been a sharp slowdown coming in, about 10.5% on Copra prices. So oil makers like Marico and Dabur stand to gain from this. Next, let's talk about PFAD, which is palm fatty acid distillate, which is used as a raw material for soaps. A 1.5% cool off in terms of a month-on-month pricing. So soap makers like HUL, you've got Godrej Consumer and Jyoti Labs. All of them stand to gain on the back of this softness. And you've also got alkyl benzene that is used as a raw material in detergents. That has also seen about a 1.5% cool off month on month. Once again, it's these soap players who also make detergents, HUL, GCPL, Jyoti Labs, that stand to gain from this. Shifting focus then, let's talk about food input cost ease, and FMCG margins may improve on account of this. On the back of that, some food-related commodities, wheat is lower by about 2.5%. So biscuit makers and companies that use wheat flour as a raw material, Britannia, Nestle, ITC, Mrs. Bector's Foods, all stand to benefit from this. Cocoa prices are lower by 2.5% month on month, and the biggest chocolate maker in the country, Nestle, also stands to gain from this. Refined soybean oil has seen a cut of 1.5%, about that much on a month-on-month basis. So edible oil makers, Marico, who makes Saffola, Adani Wilmar, Patanjali, all of these edible oil makers also stand to benefit from this. Next up, let's shift the focus to beverages and oral care. In the beverage segment, coffee has seen very flattish moves, but that is positive for coffee makers like Tata Consumer, HUL, as well as CCL products. Let's talk about maize. The extract from maize sorbitol is used in toothpaste, and toothpaste makers like Colgate, HUL and Dabur will benefit from this 2% softness seen on a month-on-month basis. Let's also talk about mentha oil, which is a cooling substance and a flavoring substance used in hair oils and cooling products. 1.5% softness there. So you've got Dabur, Marico, GCPL and Emami who stand to benefit from this. Well, this is a list of all the raw materials that have seen some softness and the beneficiaries. Remember that on a year-on-year basis, some of these commodities are still quite elevated on the back of all the geopolitical pressures that we've seen in the previous few months, albeit they're now easing. Brent crude still continues to be higher by 58% on a year-on-year basis. You've still got palm fatty acid distillate that is used in soaps that's seeing an inflationary trend, as has been the case with soybean oil, with LAB as well as mentha oil. So while we're still waiting for further moderation on this, even the month-on-month move seen in the latter half of Q1 could be very beneficial for staples earnings in Q1.
Right, okay, that's the impact of raw material prices easing and the kind of follow-through it's having for, or rather the impact it's having for most of the staple companies. And you saw that play out with Marico's quarterly performance as well, given the 45% cool-off in copra prices. That said, let's try and analyze where these stocks are. And Kunal, you were talking about a bullish call on a Nestle, for instance, day before. We've had Dabur, Marico, Unilever, all these stocks perform very well through this week. You think this strength is here to stay come next week too?
It looks like, Aisha, because it's now trickling into those large cap names which are seeing a sustainable move for themselves. More importantly, I think what we are seeing for those larger cap names are breakouts. And FMCG stocks, historically, that wherever these stocks have confirmed short-term breakouts, they've actually moved up into multi-day, multi-week time frame in a very slow, gradual manner. So when we look at the price trends and the structure of these price charts, the fact that these stocks have stopped falling and then participating on the days when the markets are showing signs of strength and then moving in a synchronized manner. When we look at all of these patterns coming together for the FMCG pack, this looks very attractive and this looks more sustainable for these stocks. I would still believe that Marico, I think, is one of the stronger ones in the pack. Nestle is, ranked number 2 in the sense of relative strength, looking at the price performance of late, as well as HUL, Britannia, Dabur. I think they are the ones which are showing signs of high potential breakout. So it depends on how one is looking at it. If you're looking at trying to catch up in terms of more of alpha, in terms of returns, then I would believe that in the likes of HUL, etc., they could be the ones which could outperform. But if you're looking for consistency and leadership, then I believe Marico and Nestle are the best bets.
And any other stocks that you would recommend to trade right now?
So yeah, there are a couple of them. In fact, out of the pack so far, from the IT pack, I think HCL Tech after this gap up move is something which starts to look attractive. So that's a stock which I would recommend at the current juncture. trading at 1130 approximately. Would look out for now the next target on higher side of almost 1165. Stop loss could be kept at 1125. And the second would be a buy on HUL. That's a stock which I was discussing earlier, trading at 2210 approximately. Would look at a target of 2280. Stop loss at 2180.
Okay. In fact, let me take it across to Darshita. She's here with that big win that HCL Tech announced this morning. $1.14 billion strategic AI-led transformation deal from Europe-headquartered Fortune Global 50 company. The contract, which runs through to December of 2031, is entirely new business and will help build an AI-driven digital workplace and enterprise network. Darshita here with the highlights.
Right, HCL Tech has announced one of its biggest AI deal wins in the recent years, and the company has signed a $1.14 billion strategic partnership with a Europe-based Fortune Global 50 company. Now, the contract will run from July 2026 till December 2031 with an option to extend it for another 5 years. Now, the biggest highlight is that this is entirely the net new business. In the simple words, this is not a contract renewed or an expansion. It's a completely new client for HCL Tech, making the win even more significant. So what will HCL Tech do? Basically, the company will build an AI-driven operating model for the client's global digital workplace and enterprise networks. Essentially, HCL Tech will use AI to modernize workplace operations, automate the processes, and improve the client's IT infrastructure. So from an investor's perspective, this is an important deal because it adds a large multi-year engagement to HCL Tech's order book, improving the long-term revenue visibility. Now, the fact that the client is Fortune Global 50 company also reinforces HCL Tech's ability to win large global transformation deals. And yes, one more thing to remember is that the entire $1.14 billion won't be booked immediately. The revenue will be recognized gradually over the contract period, creating a steady revenue stream over the coming years. And if the extension is exercised, the relationship could continue well beyond 2031.
Okay, thank you so much for that, Darshita. Sunny, if I were to ask you for your top picks within the IT basket, what would those be?
Again, coming to IT pack, would like to split it into two parts. On tier 2 or mid cap side, we believe that Coforge is likely to deliver a healthy earning growth, followed by First Source Limited. So kind of mid-10, 12% to 15% kind of growth is expected. But again, upcoming commentary during the Q1 numbers will be a key important metric to track for a remaining period of FY27. Coming to tier 1 companies, all the companies are trading at a very reasonable valuation, closer to 12 to 14 times FY28 price to earning multiple. So what we feel is that right time to accumulate HCL Tech. Again, there we have seen promoter buying that has also emerged at a lower level. And at the same time, with an investment in Sarvam AI, we believe that even that opportunity can unlock in a medium to from a medium to long term perspective. So HCL Tech followed by Infosys, where we feel that again valuations are very comfortable. But one has to keep in mind that if somebody is investing in IT pack, it need to be a kind of very patient capital, because FY27 is likely to be a muted year in terms of earning growth, and all the eyes will be on FY28 in terms of revival to a kind double-digit kind of earning growth. So patient capital, or otherwise someone can deploy capital gradually over the period of next 6 to 9 months.
Okay, that's the take coming in on what the IT stocks are up to. But banks, they've also, of course, been in focus the past fortnight, but now they've started coming up with their quarterly numbers. In fact, just last evening, you had some of the NBFCs, reason why Bajaj Finance and Finserv are holding out today, also come out with their quarterly updates. Mithali is here with a wrap.
Rightly said, so the banks, they continue to give standout metrics for the business update for Q1 FY27. On a healthy note, the kickoff has started with credit growth continuing to outpace the deposit growth. Equitas SFB, it led the pack with 70% growth seen in the microfinance portfolio, while CSB Bank also posted strong term deposit growth. Punjab National Bank's global business, it neared 30 lakh odd crore rupees of milestone, while Central Bank of India, UCO Bank and Union Bank, they continue to deliver robust credit growth, outspacing the deposits. While talking about Ujjivan Small Finance Bank, it maintained strong loan book expansion backed by healthy deposit growth. Starting off with CSB Bank, it stood out with its term deposits, which surged nearly 33% on a yearly basis, highlighting a strong liability franchise. Gross advances, they also grew nearly 24%, while the CASA deposits, they remained quite stable. Punjab National Bank, it inched closer to that milestone of 30 lakh odd crore rupees. The deposit growth, it remained healthy at over 8.5% on a yearly basis, while both domestic as well as the global business posted consistent sequential growth. Talking about Union Bank of India, it reported another strong quarter of solid credit growth, with gross advances rising 12.5% on a yearly basis, comfortably ahead of the deposit growth. Moving now to the small finance banks, so Equitas Small Finance Bank, it stole the spotlight. The microfinance portfolio has surged nearly 70% on a yearly basis, the fastest growth across the pack. Gross advances, they remain strong, while deposit growth stayed healthy, although the CASA ratio has quite moderated for this quarter. Ujjivan Small Finance Bank also reported a robust quarter for this one, with the gross loan book expanding 29% yearly. Deposits grew 25%, while the credit to deposit ratio, it remained broadly stable. Central Bank of India, it impressed with nearly 29% of growth in gross advances, significantly outspacing the deposit growth. And finally, talking about UCO Bank, also reported a strong lending momentum for Q1 FY27, with total advances up over 21% yearly, and domestic advances growing even faster at 22.5%. So overall, across the pack, the credit growth, it remains quite resilient, and the deposit mobilization and the CASA trends, they continue to be the key monitorables going forward.
Oh, yeah, absolutely. And Bajaj Finance has been the strong one. Kunal, haven't taken stock of Bajaj Finance on the charts. How's it looking?
Yeah, it's looking a little better than what it was maybe 3-4 months back, because, a couple of months back, the stock was just about going through a major grind, started to correct from 1100 levels to as low, I think, as 800 mark, till March 2026. And from those 800 levels is where the stock is now coming back into some sort of recovery. It's come back about the 200 moving average. That's a very strong positive for Bajaj Finance. Still 10% down from its previous highs or the major highs, lifetime highs for Bajaj Finance in that sense. But I would still believe that with this comeback about the 200 DMA and this in correlation with the other stocks which have moved in the pack, you look at the likes of L&T Finance, AB Capital, etc. These stocks are also back again on the verge of their fresh 52-week high. So I think in that sense, this momentum for Bajaj Finance should continue.
Okay. Sunny, if I were to try and get your sense with regard to metals, we've seen a decent correction on spot prices. Impact on the metal index in your view, and is a lot of that done and behind us?
Yeah, I think you rightly pointed out that definitely there has been a sharp correction with an ease in concern as far as Middle East war is there. So, and at the same time, there was a narrative that even in US we may see an interest rate hike, which was giving a strong upside momentum to an dollar index. So that has led to a very sharp correction in the spot prices of underlying commodities. But having said that, what we believe is that a case in point like aluminium, which has hit the highs of $3,700, $3,800, that is now trading closer to $3,000, $3,100 on a per ton basis. But if you look at analyst estimate, I think most of the analysts have built in for non-ferrous aluminium side in their model number of $3,000 to $3,100 per ton. So in terms of earning surprise, there won't be any negative surprise even if the prices continue to hover in the current range for remaining FY27. So we continue to remain bullish on non-ferrous pack, especially aluminium. And if somebody want to deploy money, I think Nalco is the best stock. And at the same time, the recently listed entity, which is Vedanta Aluminium, can also be considered. Another pack which we like among the metal is stainless steel, and the proxy play to that is chromium, for which the Indian Metal and Ferroalloys is an listed entity that we feel, because of the recent capacity addition, both organically and inorganically, can deliver a fantastic growth in FY27 and FY28. So Indian Metal and Ferroalloys is another pick from a metal pack.
Okay.